Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Hello, everyone, and welcome to another episode of the Executive Real Estate Investing Show. I'm your host, Michael Holman, and I am excited to be here with you today. I'm really excited because today is an executive questions segment, and I love these. I literally just barely sat down. My podcast manager just handed me this list of questions. I have not read these yet, so I am really excited. Once again, you are getting this totally raw questions from me and answers on how I can help you, if I can help you. I always get nervous during these a little bit because I never know what's going to happen, but I love it, right? I love getting these, and you're getting honest, true, real questions and answers. So it's going to be awesome. As always, go visit executivereishow.com. It's a great website. There's lots to do on there. You can check out all the past episodes. You can check out the resources. You can sign up for the newsletter that goes out weekly. That's awesome, by the way. I get it. I read it every single time. In addition, you can also ask one of these executive questions, right? So for those of you who are watching on YouTube, you can you see this little paper I'm holding. This is a list of the executive questions and prior executive questions. You want to get your name on this list like David C., Glenn G., Leo F., all these people that we're going to talk about today. Well, if you want to get your name on that list and you want to ask your question and have me answer it in one of these sessions, go ahead, go to executivereishow.com, sign up, and you can go ask an executive question. It's right there, I believe, on the home page, right? Couldn't be easier. Also, if you're liking what you're listening to, we want to get this out to as many people as possible, right? We're putting out amazing content. We're having amazing guests. Go ahead and leave us a rating and review on iTunes, on Stitcher, on Spotify, right? Wherever you listen to your podcast. And I said iTunes. iTunes doesn't even exist anymore, right? It's Apple Podcasts. So Apple Podcasts, no matter where you listen to, go ahead, leave us a rating, leave us an honest review. We want to hear from you, right? And go ahead and share the show, right? I mean, we love it. We get people all the time who are posting on their social media, on LinkedIn, Facebook, Instagram. I mean, we've had people post on TikTok and Twitter about the show, about things they're learning on the show, and we love it. We'll always shout out. We always love getting a shout out as well. So go ahead, share the show, leave a rating and review, and let's get into this executive tip. Today's executive tip is probably the thing that I would say has given myself in my career the most competitive advantage, and what's made me be able to grow this company, and that is to be relentless. Right? I just actually was on a podcast not too long ago for a recording, and they asked me, what is the one thing that you feel has separated you from everybody else, or the one thing that's made you successful? And as I thought about that question, the only thing that kept coming to my mind is to be relentless, right? There's always a way. And because thinking about it, I can tell you right off, right? I'm not the smartest in the room. I don't want to be the smartest in the room, and I'm not. I'm not necessarily the most intelligent or articulate, but I am relentless, right? And that is kind of the attitude and the mindset that you have to have in real estate, in business, if you are going to be successful. So once again, today's executive tip, be relentless. All right, let's dive right into these executive tips. These executive questions. These first executive question comes from David C. And David said, is there a way to get into commercial real estate when you do not have much money to invest? Great question, Dave. And David, this is a question that we actually get quite frequently, right? And it's usually from the younger generation, and we get it. Real estate investing is a very sexy thing, right? You see these real estate tycoons who have hotels and apartments and they own everything, and it's sexy, right? There is a lot of appeal to real estate and to real estate investing, and for good reason. What I always tell people when they ask me this type of question, right? The answer is, kind of, right? What I recommend is if you don't have a lot of money, right? If you have less than $25,000-$50,000 to invest in real estate, and you're looking to get into real estate, you kind of have to start off getting your feet wet, right? I mean, there's not necessarily a ton of options, and so your options are kind of limited to single family, which I know this question specifically says commercial, but single family, you can partner with people, and which I'll get into in just a second. But if it's just you're not interested in actually being like a syndicator or anything like that, to be honest, you need to go out and focus on how to make money first, right? Being a syndicator or something like that, that is a job, right? I classify that as investing as well, but that's a job. People are making a living off of that. And so when people come to me and I get these people right out of college, they're like, hey, I want to invest in commercial real estate. And I say, that's great. Okay. But you need a couple things to invest in real estate. You either need money, you need experience, or you need a whole lot of time, right? Because you have to add value to someone else in some way. Real estate investing is one of the most collaborative spaces that I have ever been a part of, right? It's a very collaborative industry. People are partnering and teaming all of the time, but you have to have something to bring to the table, right? And in most cases, that's money, right? So my recommendation, first off, right, before I give any other advice on how to get into commercial real estate with not very much money, is go out and figure out how to make money, right? Whatever that is that you are passionate about, that you love to do, that fulfills you, and that brings you a solid source of income and money that you can start investing, that is the main focus. As you're younger, as you're younger in your years and younger in your life, you really need to focus in on what is going to make you money, right? And for some people, that is real estate syndication, right? For some people, that is being a dentist or a doctor, or they own a car mechanic shop, or, there is something that they love, that they know, that they understand, and that they're driving forward. And that really has to be the focus, right? You need anybody who tells you you don't need any money whatsoever to invest in real estate at all, right? That is not true. Maybe you need a little bit of money. Even if you start off in syndication, you usually need at least a little bit of money, right? Not necessarily a ton, but a little bit. So you gotta get some cash, right? That is a super important thing. Okay, so that's step one, right? Step one is, no matter what else happens, go get a job. Now let's say, hey, I am committed. I want to invest and I don't have a lot of money. Well, I don't know exactly what that means, but let's just use an example, $25,000 as a threshold, right? The only way you're getting in commercial real estate under generally $25,000 investment, a lot of times that's going to come in the form of being a limited partner maybe. Most syndicators, their minimum raise is going to be well above $25,000. You might be able to find one somewhere who will do $5,000 or $10,000. That is very uncommon. I mean, they might be out there, but that is probably someone who's just getting started or somebody who doesn't have a lot of experience, something like that. So if their minimum is less than $25,000, I would just be cautious, right? I'm not saying you can't have a good deal with them, but just go into that eyes wide open and be somewhat cautious in that scenario. The only other ways that are coming off right off the top of my head is you can do one of the crowdfunding websites. Now you lose some of the benefits, right? I mean, those crowdfunding websites that do real estate, they're great. There's a couple of them that are like direct real estate, right? I mean, let me, off the top of my head, I believe it's CrowdStreet and Real Crowd. I think are the two. Don't quote me on that. I know CrowdStreet, but I'm not sure about Real Crowd, that are actually direct investments. And some of their investments potentially will allow for smaller investment sizes. But even then, on most of those websites, it's generally only for accredited investors. And if you have less than $25,000 to invest, you probably aren't an accredited investor, or we need to have another conversation about your money habits. Is what we need to do there. So for everybody who's wondering, an accredited investor, in general, there's some other rules, but in general, it's someone who makes over $200,000 a year for the last 2 years, or $300,000 with their spouse. So each spouse makes $150,000. You'd be considered an accredited investor, or they have $1 million in net worth, not including their primary residence. Those are the basic. That's what still most people do. The SEC not that long ago came out with some updates as far as if you have certain licenses, you're considered accredited, some things like that. But in general, the thing that most people are going to look at first off is net worth or income. Those are the two main qualifiers. So the other option, if it's not a direct, is an indirect crowdfunding website, and that's something, say, like Fundrise or Equity Multiple. So you aren't actually investing directly with the sponsor. You're investing with Fundrise, who gathers up all your money, all the people's money, and they make an investment into a sponsor, or maybe their own fund, but they're making an investment into the person who's actually doing the real estate. And so while Fundrise is getting all the benefits of investing in real estate, they are taking a hefty portion of those returns. So your returns a lot of times are similar to what you would see in the stock market, right? Because they do that because they're making it, they're trying to make it as easy to invest as the stock market. But like I said, you're really missing out on a number of the advantages, right? Most of those aren't giving any kind of tax benefits or things like that you generally are very powerful in real estate investing. So, I mean, you can do that. That's a way to do it. You can kind of see what reporting generally a sponsor would give. I mean, Equity Multiple, Fundrise, all those groups, they're going to have you're only going to interface with them. You might not even know who the sponsor is at the end of it. You might only know the deal that you're investing in. But they really insert themselves right in the middle of that transaction and take a hefty portion. So your returns, they can be better than the stock market, but a lot of times they're going to be 6-8%, maybe up to 10 or something like that. But you're not in the 15-20% range that, for example, most of the investors on a development deal that I would do is a part of. The other way that I'm thinking of is you can go through some stocks or that is a possibility. Once again, you miss out on really all of the benefits because once again, you are investing in a stock, right? You're not investing directly into real estate. So you're investing in a company that invests in real estate. And that company is the one that receives all of the benefits of investing in real estate, all the tax benefits. So you're just investing in that company, right? There's some good ones, right? There's some that pay 5-6% dividends, which, not bad, right? But at the end of the day, you're investing in a stock, not directly into real estate. So those are a few ways. Now, let's transition a little bit on that question and say, okay, well, what if in that scenario I want to do real estate investing And I don't necessarily have to be passive, right? I mean, if you want to be an active investor, there are options. You can become a syndicator, right? And you have to go out and you have to make connections and you have to talk to people. You got to find the deals. You got to, whether it's a development or acquisition or whatever the case may be, value add, whatever you're trying to do, you, at the end of the day, you have to gain enough knowledge and comfort to be able to do that entire transaction and raise all of the money. And you can do that with less money, right? I mean, you don't need, $1 million to start in that. You can start potentially with as low as 25, 50,000, potentially. Right now, you still have to pay for a lot of upfront costs. You're still going to have skin in the game. So I'm not going to tell you can have $0 and go become a gajillionaire through syndication, right? That to me is almost a little dishonest, because syndication is really hard and it takes a lot of time, money, and effort, right? Now, that being said, it is possible. So don't get me wrong. I'm not saying don't do it, but I'm saying just know what you're getting into. A lot of people start getting into that space, and there's a lot more that fail than succeed. And you can be one of the ones that succeed, but one of the keys is having the right expectations in the very beginning going forward. So that is a possibility, right? If you want to, and like I said, that essentially turns usually into your job, right? That is what you do full time. You spend your time, effort, money building that business, right? You essentially become a business owner. So, it's as far as just investing passively and getting these great returns, honestly, there's not a ton of options, but I've laid out everything that I can possibly think of right here in the moment to try and help you at least get your feet wet and get thinking about it. All right, let's get on to this next question. Next question is from Glenn G. And Glenn asked, explain cash on cash return and how it relates to the total returns you get from your investment. Great question. Cash on cash, you hear a lot of gurus and other people, cash flow, cash flow, cash flow. And that's really important, right? So cash on cash return is simply the cash, like the actual cash that you receive from your investment divided by your total investment. So if I made a $100,000 investment, and in any given year, I received $5,000 from that investment of actual money that went into my bank account, that would be 5,000 divided by 100,000. That would be a 5% cash on cash return. Now, some people focus solely on cash return. What is that? That's their driving decisions on that. Now, there's more that goes into that, right? Because generally on a real estate investment, there's a few different things happening here. 3 of the main things that I always talk about that kind of make up your return, your cash return, so your cash on cash return. That's just money that you're getting from operating the property. You're also usually appreciating in value, right? So you're going to get some benefit generally. Now it depends on the market and the asset, but hopefully you're getting some appreciation in the value of that asset. That one is really important for me. As a developer, my cash return is minimal. I mean, for the first 2-3 years of a big apartment development, my investors receive 0 cash, right? 0. But we create massive amounts of value through the development, right? So it might look that, hey, yeah, years 0 through 3, there's none. But in year 3 or 4, we refinance, can get all the equity capital back. And then you're getting a 7 or 8% cash on cash return forever, right? That just continues to grow. And so for me, cash on cash return is less important because I'm more focused on development, on creating value. So that's one of those things, that appreciation in that value. The third thing is a reduction in your loans. So equity buildup, right? Every time you're paying that loan, assuming it's an amortized loan, your equity is building up. And when you go to refinance or sell the asset, you get to capture that equity buildup, right? So there's more things that go into that, but that's the 3 main things that I usually talk to people about that factor into return. The most common one, the most focused, the one that gets the most attention and focus on it is generally cash return or cash on cash return, right? Because that is the actual money, the immediate that's coming right in. And so that plays in a big part. Now, that being said, you look at one of my developments, for example, right? I got one development. The average cash on cash return, is at stabilization is in the 7-8% range, right? Not bad, but it's not 15%. But my total return is well over 20%, and that's because in that development situation, right, we built the project for a lot less than market value. And so while 7-8%, you're getting that, and that's kind of making up your return, it's actually not the biggest piece of like your annualized return in one of my deals. Generally, usually a bigger piece is going to be the value creation, right? So if your cash on cash return might be, say, let's call it 6% in one of my deals, but your annualized return is at 20%, that 14% of that 20% is being made up through value creation, equity buildup, probably with the vast majority of that being value creation. And so it definitely relates, and it's different for different investment types. There's different thresholds for whether it's a new development, whether it's a value add, whether it's a core, stabilized property. There's different thresholds, but it is just one factor, right? It's a factor that gets focused on a lot. It's important, but it is a factor that makes up really the entire return that you receive on a real estate investment. Okay, getting into the next question. This one is from Lawrence S. What cap rate do you consider good to above average in this market? Sorry, Lawrence, I do not know which market you're in. Let's see if you specify in regards to self-storage, or pick another market. Okay, all right, perfect. Cap rates. Right now, by the time I tell you what I think right now, it's probably going to be different from when this episode actually gets released, right? So I'm going to tell you as of right now, know that this is probably going to change, right? And cap rates are different and vary. Here's what I'll say. I'll take one of the projects in the Phoenix Metro. All right, that's a market we build in a lot. In the Phoenix Metro, let's call it in a suburb of the Phoenix Metro, on a large 200 plus unit apartment, right? We're seeing cap rates right now on those type of properties, new build, stabilized core assets, being in the low 4s, 4.25. We've seen some as low as 4. Kind of 4 to 4.5 is what we're seeing on cap rates. Now, those have continued to go down. I don't know, something might happen between when we're recording this and when it gets released that those go way up. But at the time, right, 4 to 4.25 in the core multifamily new build, new development space is very common, right? It gets a little bit higher for self-storage. So in general, apartments are one of your lowest cap rates, right? So multifamily is a really low cap rate. You kind of go up the chain. You have like triple net lease, are pretty low cap rates. A lot of those, even in tertiary markets, those are going at 5.5 to 6.5%. In primary markets, they go for a lot lower than that. But those are viewed as really, really safe and have really low cap rates, especially if the shorter your lease term, the higher cap rate is going to be. But if you got you just signed up a brand new 20-year lease with a national credit tenant, triple net lease, that's going to be a very low cap rate. As you kind of move along that chain, industrial right now, in a lot of areas, industrial is really hot. That's got a really low cap rate. Built for rent has a really low cap rate comparatively. Hospitality generally has a higher cap rate, right? Hospitality, most of the time, and this varies widely on market, but can range anywhere between 7 to 9.5% on a cap rate. So their cap rates are generally a lot higher than what you would say in like multifamily. That's because those projects generally are throwing off more cash, and there's less value creation necessarily. So hospitality is pretty high. that kind of gives you some of the spectrum, right? Office varies widely, and especially right now, it's all over the place. In some markets, office is doing really, pretty well. In some, in some markets, office is really struggling. Office is all over the place. I can't even begin to guess. That is so market specific. I'm not even going to give you a generalization on office. But hopefully that kind of gives you a good idea, right? I mean, generally cap rates are, in your self-storage, right now they're getting down as low as, 5.5%. You talked to me 2 years ago, we were kind of underwriting 6.5%. A lot of my apartment deals right now, right, are being underwritten at like 5%, which is, half to 3/4, half to a full percent higher than what they're actually trading at right now. So we try and be conservative in those regards, but hopefully that's giving you, Lawrence, kind of a general broad idea. Okay, next question comes from Leo F. And Leo asked, in the recent past, a lender said that apartments should not be more than $130,000 per door. What are the lenders saying these days, price per door? All right, Leo, good question. And the answer, in some markets, yes, right? This is so market specific and lender specific, right? Each lender has a very wide, there's a very wide berth among the different lenders on what they view as good or not good, right? And what they tolerate and what they view as too risky. So in some markets, $130,000 per door, that might make sense, right? In some of the markets like we're in, I mean, I look at the $130,000, and at least right now in the Utah and Arizona market, which are our main markets right now, we could, $130,000 doesn't exist. $130,000 per door, that doesn't exist. That's not a thing. At least not in the greater Salt Lake and Phoenix areas. We're easily double that, right? If not 2.5 times that. But I would say on average, we're probably about double that. Our average is probably going to be 250 to 300 right in there. Can get a little more, a little less, depending on the asset. And I don't really hear, each lender, when you usually get started in real estate investing, you think every lender is exactly the same, right? A lender is a lender is a lender. Not true at all. Every lender is very, very different, especially when you get into the commercial space. So what lenders look at, what they want, what they analyze can vary greatly lender to lender. And for example, I've never had, they're all looking at my costs, my lenders, but no one specifically has ever come to me and discussed specifically my per door cost on a project, right? That's not something that they necessarily, obviously they can extrapolate and think about it, but that's not something that they're usually bringing up with me as I have to cross this specific threshold or be under this threshold in order for them to do a loan. It varies widely, right? And like I said, every lender is going to look at something different. Well, I'll tell you, if you're in the Utah, Arizona markets and you're building something at $500,000 a door and it's garden style apartments, yeah, it's probably too expensive, right? If it's $100,000 a door, you think you're probably lying. So to give you kind of a range, but like I said, in the markets that we're in generally, on like my costs and what we're seeing a lot of times, we'll be 250 to 300, give or take, with where things are at right now. Okay, last question. And this one's actually, they didn't give us a name, so it's anonymous. So anonymous, whoever you are, asked, how does liquidity work? If you need to exit an investment during the hold period, and in regards to multifamily. So what I'm gathering, and I'm going to have to infer here a little bit, but what I'm assuming is being asked is, hey, if I make an investment into probably a real estate syndication, how liquid is that investment, You know, if I need to get my investment back during that period, can I do it? Here's the answer. It depends on the sponsor. And what we tell, like for us, what we tell every single person, and this is a good rule of thumb, no matter what syndication you invest in or who your sponsor is, that investment, you have to expect that that investment is not liquid, right? That is an illiquid investment for the hold period, at least. And one thing to note is that hold period, that is an estimate, right? A sponsor is doing their best to say, this is what we anticipate. But most sponsors give themselves the latitude, and this is for good reason, to be able to say, you know what, we anticipate this and we're going to try and hit this. But this isn't like a hard and fast date. It's not like if we have a 5-year hold at the end of month 60, we sell no matter what, right? There's some discretion there. And that's because if the market tanks in year 55, you're not going to sell it and lose a bunch of money, right? That would be ludicrous. You're going to hold on to it. You're going to keep it until, you know, maybe it's 7 years, maybe it's 10 years, things recover, get back, right? But so for that hold period, you generally, and honestly, from the time you make that investment, I would just assume that cash is illiquid. Now, that being said, us, and I know a lot of sponsors do this, we are happy to replace you. We know that things come up, right? If you have this super urgent crisis come into your life that necessitates that you need that money back, I have yet to say no to somebody who needed their money back. It doesn't happen very often, to be honest. You know, there might only be, we might have 150 investors on one deal, and on that, I might have one or two at most that at any given time say, hey, I need my money back. It happens, and I get it, and I have yet to go back to them and say, no, you can't have it. Usually is all we do. We can't give them the benefit, right? I mean, if we don't have a stabilized asset, we can't increase their price. We haven't sold it. We can give them their money back, so they might be losing out on some of the benefit, but we'll usually just replace them with another investor, right? There's usually a long list of people who want to come in who didn't get in, and we'll usually just replace them. So the answer is it's illiquid. You got to plan on it being illiquid for that investment time frame, at least. But that being said, depending on the sponsor, and like I said, for us, for example, we have never told somebody that they can't have their money back when they asked for it back or when they needed it for any reason. And it's not very common, but we've always been able to just replace it, usually within a day or two, if not less, and just keep things going. So take that for what it's worth. Right? There's the formal answer is it's a liquid, but I've kind of given you the side note and talk with your sponsor. Depending on your trust level and your confidence with the sponsor, they might be able to work something out depending on the circumstances. Okay, that is all the executive questions that I have and that I've answered. I hope you've enjoyed it. Totally raw, totally off the cusp, but you know what? That's the way we like it because you get the honest answers, not scripted at all. Once again, as we wrap up here, if you want to ask a question, you have a question that you want me to answer on this podcast, that you want your name to appear on this sheet that I am holding in my hands right here, go to executivereishow.com, click on Ask an Executive Question. You can type your question, and boom, it will show up in one of these future episodes. And I will get it answered. You can also go there, check out the past websites or the past episodes and see everything that's going on. Sign up for the newsletter. It's a great newsletter, right? You're up to date on the podcast. There's blogs that come out, a lot of good information and resource. That newsletter is actually growing quite rapidly right now. So love for you to be able to get that information just directly right into your email every single week. It happens like clockwork. Lastly, go leave us a rating and review. Go tell your friends about this. We want people to know about this. The more people that know about this, the more people can experience financial freedom, right? They can experience real estate investing. They can help grow their net worth, their family worth. They can leave a legacy for those who they leave behind. We'll see you next time.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.